There are moments in politics when power is tested not through speeches, not through rallies, not even through elections, but through consequences. One of those moments arrived at 5:47 a.m. Eastern Standard Time on Monday, February 23, 2026, when Donald Trump decided to impose a sweeping 25% tariff on all goods entering the United States from Canada. It was not preceded by careful diplomatic signaling. There was no extended negotiation, no gradual phase-in period, no quiet back-channel preparation. It was delivered bluntly, publicly, and with the unmistakable intention of shock. Inside Manhattan boardrooms that morning, the reaction was not applause. Screens at the New York Stock Exchange began glowing red as futures contracts adjusted in real time. Analysts scrambled to interpret what a full-scale trade rupture with America's largest trading partner would mean. Phones lit up between Wall Street and Bay Street in Toronto. Trading algorithms recalculated supply chain exposures. Within minutes, the cost of confrontation was no longer theoretical. 3 weeks earlier, speaking at Mar-a-Lago, Trump had framed the coming move as overdue justice. He described Canada as taking advantage of the United States, promising that tariffs would force a renegotiation of trade terms and bring manufacturing jobs back across the border. The logic was simple and familiar. Economic size equals leverage. The United States is bigger. Therefore, Canada would bend. Trump's political identity has long centered on tariffs as a weapon. During his first term, he wielded them against China and others. In his view, they were proof of strength. But this time, the target was different. The relationship between the United States and Canada is not merely transactional, it is deeply integrated. For decades, the two economies have functioned as extensions of one another. Under the United States-Mexico-Canada Agreement, supply chains became even more intertwined. Auto parts cross the border multiple times before a finished vehicle rolls off an assembly line. Energy grids are linked. Agricultural flows move seamlessly. The tariff announcement was not a narrow strike. It was an earthquake through a shared economic foundation. At 11:43 a.m. on Thursday, February 20th, Trump made the move official with a short post on Truth Social. The message was concise and absolute: a 25% tariff on all Canadian goods, effective immediately. No exemptions, no transition. For 4 minutes, markets hesitated, as if unsure whether the post was genuine or a glitch. Then, the recalibration began. 9 minutes later, at 11:52 a.m., cameras in Ottawa switched on. Canada's newly elected Prime Minister, Mark Carney, stepped forward without visible notes. His demeanor was calm, almost clinical. Before entering politics, Carney had served as governor of the Bank of England and previously led the Bank of Canada. He was not a career populist. He was a technocrat shaped by financial crises, including Brexit-era volatility. He understood how markets think and, more importantly, how they react. Carney announced immediate reciprocal tariffs on American goods. He declared that Canada would accelerate trade diversification talks with partners in Asia and Europe. He promised emergency financial support for affected Canadian industries. Then he introduced a detail that sent a chill through parts of the American Midwest. Canada would examine restrictions on energy exports to U.S. states heavily dependent on Canadian natural gas and electricity. There was no raised voice, no theatrical indignation. The tone was steady, almost mathematical. The contrast with Trump's dramatic announcement could not have been sharper. Yet in that calm delivery was a strategic reversal. The assumption in Washington had been that Canada would hesitate, perhaps plead privately for exemptions. Instead, it retaliated publicly and instantly. As Carney spoke, American markets began to slide. Shares of major automakers dropped within minutes, reflecting the reality that North American vehicle production relies on components moving back and forth across the border multiple times. Energy companies with exposure to Canadian supply chains declined. Traders rushed to model worst-case scenarios: prolonged tariffs, retaliatory escalation, legal disputes under USMCA provisions. Within 15 minutes of Canada's response, 3 major American business groups broke with the White House. The American Petroleum Institute, the National Association of Manufacturers, and the U.S. Chamber of Commerce each issued statements opposing the tariffs outright. Not cautious concern, not diplomatic language, Direct opposition. By the closing bell, the S&P 500 had fallen 127 points. More than $400 billion in market value evaporated in under 6 hours. For investors, this was not about nationalism or rhetoric. It was about risk, cost structures, and predictability. Markets reward stability. They punish uncertainty. On that day, they delivered a verdict. Reports from inside the White House suggested that by 12:30 p.m., an emergency meeting had been convened. The conversation, according to leaks, was not about how to intensify the pressure, but how to contain the damage. Advisors reportedly questioned whether Canada's response had been fully anticipated. One pointed out that Carney was not an inexperienced politician, but a former central banker who had navigated financial storms at the highest levels. The frustration, insiders said, was visible. Threatening China or Mexico had been framed previously as a contest against strategic competitors. Threatening Canada carried different optics and different risks. Canada is not merely a neighbor, it is an ally with alternatives and alliances of its own. Carney's rapid response had not been improvised. According to sources in Ottawa, contingency planning had been underway for months. Scenario exercises had examined precisely this possibility, a sudden American tariff shock. The 9-minute turnaround was not spontaneous bravado. It was a rehearsed execution of a pre-approved plan. Politically, the move transformed Carney overnight. Elected on a platform of competent economic stewardship, he now appeared decisive in defense of national sovereignty. In Canada, strength against perceived American aggression plays well across party lines. Trump's attempt to demonstrate dominance instead unified Canadian politics behind its new leader. The legal dimension further complicated the crisis. The USMCA, personally negotiated and signed by Trump during his earlier presidency, contains specific procedures governing tariffs and dispute resolution. Canadian officials signaled they would initiate formal complaints under those mechanisms. Legal experts argued that unilateral tariffs without proper justification could violate the agreement's terms, including most favored nation obligations and established processes for safeguard measures. If a dispute panel were to rule against the United States, the damage would extend beyond this episode. It would raise broader questions about the reliability of American treaty commitments. For global partners watching closely, credibility matters as much as power. The economic ripple effects were immediate and layered. American companies dependent on Canadian inputs faced an abrupt 25% cost increase. They had two options: absorb the costs, cutting into profits and depressing stock valuations, or pass them on to consumers, fueling inflation. Neither option aligned with political messaging about economic prosperity. Energy risks loomed as well. Several Midwestern states rely heavily on Canadian electricity and natural gas. Even partial restrictions could strain grids during peak demand. Manufacturing facilities operate on tight margins and tight schedules. Power instability translates into shutdowns, layoffs, and cascading regional economic effects. Swing states, many of which formed the backbone of Trump's electoral coalition, were particularly exposed. If unemployment ticked upward due to trade disruptions, the political consequences could be swift. A strategy intended to signal strength risked undercutting the very communities it claimed to defend. Abroad, governments took note. The European Union observed a Canadian Prime Minister responding forcefully and effectively to American tariffs. They saw U.S. markets penalizing the move. For Brussels, it was a case study in coordinated counterpressure. Beijing watched as well, analyzing how rapid retaliation reshaped leverage. When threats cease to produce compliance, they lose potency. The business community's silence was telling. Executives who had previously attended events at Mar-a-Lago were notably restrained. Companies such as Tesla, whose supply chains intersect with Canadian materials and components, faced immediate exposure. Public support for the tariff strategy would have required endorsing policies that directly harmed their own balance sheets. Boards and legal departments, not campaign stages, set the tone. Inside Trump's political coalition, tensions deepened. The populist base responded favorably to rhetoric about American toughness, but multinational corporations and trade-dependent industries, traditional pillars of Republican fundraising, recoiled. A coalition divided between economic nationalism and corporate pragmatism struggles to sustain unified momentum. Reports indicated that Trump monitored coverage closely, frustrated by headlines juxtaposing his abrupt announcement with Carney's composed reply. Polling data suggested independent voters were uneasy about escalating trade conflict with a close ally. Congressional Republicans privately voiced concern about economic fallout in their districts. The market decline became more than a financial statistic. It functioned as a real-time referendum by investors trained to assess risk objectively. Thousands of portfolio managers, analysts, and traders independently reached similar conclusions. This policy increased instability. Trump had sought to demonstrate that economic size alone guarantees leverage. Yet in a globalized system defined by interdependence, size does not eliminate vulnerability. When supply chains are integrated, disruption harms both sides. When allies possess alternatives, coercion invites counter-coalitions. Escalation remained possible. Trump could expand tariffs to additional sectors or threaten withdrawal from USMCA altogether, igniting a full-scale North American trade war. But even if he did, the core dynamic had shifted. The assumption that Canada would capitulate had been disproven in 9 minutes. International relations scholars will likely study this episode as a turning point. Not because tariffs themselves are unprecedented, but because the speed and coordination of the response challenged a foundational belief in unilateral dominance. Economic statecraft relies not only on power, but on credibility. Once markets and partners doubt the strategic foresight behind threats, deterrence weakens. Meanwhile, dispute resolution proceedings under USMCA loom. If Canada prevails legally, the precedent could constrain future American tariff actions. If the United States refuses to comply, broader confidence in treaty enforcement could erode. Either outcome reshapes perceptions. As the days unfold, the White House faces narrowing options. Retreat risks appearing weak to supporters. Escalation risks deepening economic damage. Compromise requires acknowledging miscalculation. None are politically comfortable. In Ottawa, Carney's stature has grown. By responding swiftly, he reframed the narrative from Canadian vulnerability to Canadian agency. The episode demonstrated that in modern trade disputes, preparedness and alliances can offset asymmetries in size. In financial markets, volatility remains elevated. Analysts continue modeling inflationary impacts, sectoral exposures, and energy contingencies. Corporate executives adjust guidance. Governors of border states consult with industry leaders. Every move now carries amplified consequences. Power in the contemporary global economy is not measured solely by GDP or military strength. It is measured by networks, trust, and the ability to anticipate second-order effects. When a policy move triggers immediate market backlash, unified foreign retaliation, and domestic business opposition, it reveals the limits of unilateralism. The 9-minute interval between announcement and response crystallized that lesson. A tariff intended as a show of dominance instead exposed interdependence. A message designed to intimidate catalyzed coordination. A strategy meant to isolate a neighbor risked isolating its author. The coming months will determine whether this confrontation cools through negotiation or hardens into prolonged conflict. Dispute panels will convene. Lobbyists will intensify efforts. Markets will react to every signal. But one reality has already emerged. In an era of integrated economies and instantaneous communication, threats do not operate in a vacuum. When consequences arrive faster than anticipated, they redefine the battlefield. And on that February morning in 2026, the balance of economic power did not simply hinge on who was bigger, it hinged on who was prepared.